Technical analysis is a method of predicting the future price movements of a security based on its past trading activity, such as price and volume. Technical analysts use various tools and indicators to identify patterns and trends that may not be obvious to the average investor. In this section, we will discuss how to use technical analysis or charting to spot these opportunities and profit from the stock market's blind spots. One of the most basic tools of technical analysis is a chart. A chart is a graphical representation of the price history of a security over a certain period of time. Charts can be displayed in different formats, such as line, bar, candlestick, or point and figure. Each format has its own advantages and disadvantages, depending on the type of analysis and the preference of the analyst. For example, candlestick charts show the open, high, low, and close prices of each trading session, as well as the direction and magnitude of the price change. This can help analysts identify bullish or bearish signals, such as reversal patterns or continuation patterns. Another tool of technical analysis is a trend line. A trend line is a straight line that connects two or more significant points on a chart, such as highs or lows. Trend lines can help analysts determine the direction and strength of a trend, as well as potential support or resistance levels. For example, an upward trend line can act as a support level for a rising price, while a downward trend line can act as a resistance level for a falling price. A break of a trend line can indicate a change in the trend or a breakout. A third tool of technical analysis is an indicator. An indicator is a mathematical calculation that is applied to the price or volume data of a security to generate signals or values that can help analysts make trading decisions. There are many types of indicators, such as moving averages, oscillators, momentum indicators, volume indicators, and sentiment indicators. Each indicator has its own formula and interpretation, depending on the purpose and context of the analysis. For example, a moving average is an indicator that shows the average price of a security over a certain number of periods. A moving average can help analysts smooth out the price fluctuations and identify the direction and strength of a trend. One way to use technical analysis or charting to spot patterns and trends that may not be obvious to the average investor is to combine different tools and indicators to form a trading system or strategy. A trading system or strategy is a set of rules or criteria that defines when to enter and exit a trade based on technical analysis signals or values. For example, a simple trading system could be to buy a stock when it crosses above its 50-day moving average and sell it when it crosses below its 50-day moving average. A more complex trading system could involve multiple indicators, such as stochastic oscillator, relative strength index, RSI, and moving average convergence divergence, MACD, to confirm the signals and filter out false ones. By using technical analysis or charting to spot patterns and trends that may not be obvious to the average investor, you can gain an edge over the market and increase your chances of making profitable trades. However, technical analysis is not a foolproof method and it requires practice, discipline, and risk management. You should also be aware of the limitations and assumptions of technical analysis, such as technical analysis is based on historical data and does not account for future events or fundamental factors that may affect the price of a security. Technical analysis is subjective and different analysts may interpret the same chart or indicator differently. Technical analysis works best in liquid and trending markets and may not be reliable in illiquid or sideways markets. Technical analysis may generate conflicting or lagging signals that may lead to confusion or losses. Therefore, you should always do your own research and test your trading system or strategy before applying it to real trades. You should also use technical analysis in conjunction with other forms of analysis, such as fundamental analysis or news analysis, to get a more complete picture of the market situation and potential opportunities. Cognitive biases and blind spots are mental errors that can affect your judgment and decision-making in the stock market. They can cause you to make irrational choices, ignore relevant information, overvalue your own opinions, and miss out on profitable opportunities. In this section, we will discuss some of the most common cognitive biases and blind spots that investors face and how to avoid them. One of the most common cognitive biases is confirmation bias. This is the tendency to seek out and favor information that confirms your existing beliefs and ignore or dismiss information that contradicts them. For example, if you are bullish on a certain stock, you might only read positive news and analysis about it and ignore any negative or neutral signals. This can lead you to overestimate the prospects of the stock and overlook any potential risks or challenges. To avoid confirmation bias, you need to actively seek out and consider different perspectives and opinions on your investments. You should also be open to changing your mind when new evidence or information emerges that challenges your assumptions. You should not be attached to your beliefs or opinions, but rather base them on facts and logic. Another common cognitive bias is recency bias. This is the tendency to give more weight to recent events or information than to older or more distant ones. For example, if a stock has performed well in the past few weeks or months, you might assume that it will continue to do so in the future and ignore its long-term performance or fundamentals. This can lead you to chase trends or fads and miss out on more stable or undervalued stocks. To avoid recency bias, you need to look at the bigger picture and not be swayed by short-term fluctuations or noise. You should also have a clear investment strategy and goals that are based on your risk tolerance, time horizon, and financial objectives. You should not let your emotions or impulses dictate your investment decisions, but rather stick to your plan and review it periodically. A third common cognitive bias is anchoring bias. This is the tendency to rely too much on the first piece of information you receive or encounter when making a decision. For example, if you see a stock trading at $100 per share, you might anchor your expectations and judgments around that price and ignore other factors that might affect its value. This can lead you to overpay for a stock or miss out on a bargain. To avoid anchoring bias, you need to do your own research and analysis on a stock and not rely on external cues or references. You should also compare different sources of information and data and look for discrepancies or inconsistencies. You should not let the initial price or value of a stock influence your perception of its worth, but rather evaluate it based on its intrinsic value and growth potential. These are just some of the cognitive biases and blind spots that can affect your judgment and decision-making in the stock market. By being aware of them and taking steps to avoid them, you can improve your chances of profiting from the stock market's blind spots.